Data from Polymarket shows that a 90% chance the Fed will hold rates steady, with just 10% betting on a quarter-point cut. Joining us to discuss the rate debate and the changing face of the Fed, Yahoo Finance senior reporter Jennifer Schonberger is with us, getting ramped up for 2026 and what's going to be, I mean, listen, you're always busy, Jen, but it's going to be particularly busy this year because of some of the shuffling in staff at the Fed.
Good morning, Julie, and Happy New Year to you. I don't think we have spoken since the new year has started. Yes, this feels like a little bit of the calm before everything takes off. We know that there are now 4 new voting members on the Federal Reserve. Cleveland Fed President Beth Hammack and Dallas Fed President Lori Logan, both of whom are hawkish. And we also have the new head of the Philadelphia Federal Reserve, Anna Paulson, who has called for further modest rate cuts later this year. She's less concerned about inflation, more concerned about the job market. She believes that the higher prices that we have seen from tariffs are not leading to broader inflation. And she pulled out a stat over the weekend during a speech in which she said that, look, 90% of the job creation that we've seen over the past year through November has come from healthcare and social services. So she's more concerned about the job market. And then the 4th member who is going to be a voting member this year, who is, I should say, is Neel Kashkari of the Minneapolis Federal Reserve. We haven't heard from him lately, but the last we did, he seemed to be leaning more hawkish. He said that the bar for further rate cuts is higher. And of course, as you know, we expect a new Federal Reserve chair who will take the helm in May. And that could also have dovish implications for the Federal Reserve. So a lot of moving parts, perhaps a lot of the action not taking hold, though, until the second half of this year.
Yeah, and there's also the idea, there's a lot of data between now and then. And it's especially going to be in focus even more, Jen, because of the legacy from the government shutdown, right? And you and I have talked to a lot of economists who have said, the data is not really going to be of high quality until we start to get into January and beyond. So the jobs report this week, the inflation data next week, we're really going to be focused on that. We always do, but even more.
Right. So we are, as you said, going to get a jobs report this Friday for December, and it will be perhaps one of the more first cleaner readings on the job market than we have seen previously post-government shutdown. If you'll recall, with the November jobs report, that was a bit muddy because it was later. The collection process was a bit difficult. So this is going to be a first clean reading, if you will, on the job market. Expectations are for 55,000 on payrolls. That will be a drop down from the 64,000. Again, take that with a grain of salt for November. And the unemployment rate expected to actually tick down 1/10 of a percentage point to 4.5%. So I would expect the Fed to be happy with that job report. I don't think that they would be acting to cut rates on that, because one of the primary indicators they look at when it comes to the job market is the unemployment rate. And so the fact that it's ticking down to 4.5% has historically been very low employment, considered maximum employment. So I see the Fed holding steady at the end of this month. And, we've got a lot of hawks on the committee. I mentioned Beth Hammack and Lori Logan, both whom are content to hold rates at this point. They're concerned about inflation. So I think we're going to see that tug and pull as we go through the first half of this year. Also, the fact that Fed officials already did 3 insurance rate cuts at the end of last year. So they're going to want to see what impact that is going to have. There's some lag effects there. And they expect a stronger economy for this year, especially in the first half, as a lot of consumers, Americans, are expected to get some nice tax rebates from the new One Big Beautiful Bill, as well as a bit of a rebound in growth from the government shutdown in the fourth quarter, rebounding in the first quarter. So there's a lot of moving parts here that we're going to have to take a look at. So I don't really see the Fed moving much in the first half of this year.
Yeah, we'll see how it all plays out. Jen, thanks so much.
Thanks.
As the flow of economic reports gets back on track, lawmakers continue to work towards avoiding another government shutdown that would further complicate the path for rate cuts. It doesn't look as likely this time, though, thankfully. Here to discuss all of this, Wolfe Research chief economist Stephanie Roth and Collin Martin, head of fixed income research and strategy for the Schwab Center for Financial Research. Guys, thanks for being here. Good to see you both here in 2026. I want to start with the jobs report on Friday because, it feels like the first big thing of 2026, right? What do you think it's going to show, Stephanie? And how seriously do we take? Is this indeed a clean report, so to speak, after the shutdown?
Yeah, I think it's fairly clean. We're looking for 75,000 on non-farm payroll, so a little higher than consensus. I think importantly, you'll start to see a broadening out of the payroll gain. So that's going to be the thing that we're looking for most closely.
So beyond healthcare that Jen was just talking about.
Exactly. Yeah. So a better picture than what Jen was alluding to, which what we saw last year, where through the bulk of 2025, it was mostly healthcare and social assistance driving it. So the more defensive parts of the economy. Our expectation is you'll start to see the broadening out as the economy improves a bit, the tariff-related uncertainty gets better, in which case you'll start to see the pickup in the economy driving employment gains a little bit higher. And then on the unemployment rate side, our expectation is 4.5, but the risk is that you end up getting 4.4 because you get a reversal of the shutdown-related pop in unemployment.
Interesting. And I know there were a lot of questions about the unemployment rate last time and what went into that. So that'll be interesting. I think you guys are at 4.5% also for your estimate, Collin. What is the market expecting? So if you're focusing on bond yields, for example, how are they setting up going into the report?
Well, I think a lot of it's going to come down to whether this, beats or underperforms expectations. We don't put out official forecasts.
Gotcha.
4.5, I think, is the consensus.
Yeah.
I think that would be really well received by the markets. We got that increase to 4.6 in December or November rather. Mm-hmm. What was driving the increase? I think there's a lot of moving parts there. It could have been more entrance to the labor force, things like that. But I think an upside or downside surprise will be important to watch here. If it goes up a little bit, I think that would spook the markets a little bit. Building on what Jen just said, the Fed and Fed officials do focus on that unemployment rate. If it goes down to 4.5 or even 4.4, as Stephanie just said, I think that would be really good. I think the markets would kind of.
So we're in a bad news is good news is bad news situation?
Well, for the bond market, bad news. Well, no, not necessarily. I think if we get bad news, if we see the unemployment rate rise, that would likely take some of the hawks and maybe pull them away from their hawkish tilt. And that would likely pull down yields. That would be good news for the bond market. But obviously, it wouldn't send good signs about the economy.
Right. Okay. Do either of you think there's any chance that we get a cut in January?
No.
I think the odds are quite low.
Yeah. Okay. And then how does that play out then? As we start to get, I think the newly composed Fed won't entirely be in place till March. And so do we wait until then to see a change?
I think this is the last cut under Powell, or this was the last cut under Powell, in which case, we're talking about a couple cuts later in the year. But now, look, we're talking about the more hawkish members are going to be joining in the first half of the year. Then you get a more dovish Fed chair for the back half of the year. At that point, you'll probably see the boost from fiscal start to fade. The tariff-related inflation, Q1 seasonality on CPI will start to fade. So it'll be easier for the Fed to cut in the back part of the year, one led by a more dovish chair, and then on top of that, the data will support the ability to cut at least a little bit more.
Okay. And do you see a similar scenario?
Yeah, I think so. I think they're going to pause for a little bit. I think this year might look a little bit like last year, where they basically took not just the first half off, they took almost 9 months, 8.5 months off before they cut again. I think that's what we'll see right now. When we look at the rotation of the Fed, presidents and voters, the makeup's not going to be too different than it was last year because some of the outgoing voters were also hawkish, right? I mean, Goolsbee dissented, Musalem, Schmid. So we're kind of just replacing those. I don't think it changes the math too much. In terms of who will be the Fed chair, if it's just one new governor replacing Myron as he goes out, I don't think that really changes the math too much. But then you have the outlook for Powell, of course. Will he stay or will he go? And then the Lisa Cook situation. That changes the math a little bit. But if it's just one governor kind of coming in to replace Myron and then we get a new chair, our outlook wouldn't really change too much. They're probably on hold for the next handful of meetings.
If Powell, this is just me wondering, like, I would love to be in that room if you get Powell and Hassett, for example, or some of these combinations, right? Yes, I know they're all professionals and it's a very weighty job that they do, yada, yada, yada. But still, the personal dynamics are going to be interesting going into this year. I don't know if it'll affect policy. But maybe it'll be reflected in the minutes. Who knows?
Yeah, I don't know. I mean, the minutes, they don't really give us too much either.
No,
we might have to
they
wait,
don't
what,
give too
5
much.
years or so until we
To
get
get the
full
full
meeting?
minutes. Okay, so that's just me hoping for a little drama. What about what happens with rates this year, Collin? We've talked about your outlook for this year. What would change your outlook? What are the sort of pivot point swing things that you're looking at?
I think a lot of it hinges on the economic growth trajectory. If growth is expected to stay strong, at trend, maybe a little bit above trend, our outlook hasn't changed. We're expecting a steeper yield curve, slightly lower short-term rates, long-term yields like the 10-year holding near 4%, mainly because inflation's still sticky. We have a lot of supply coming. We've seen an increase in global bond yields. If growth slows, the Fed will probably cut more than we're anticipating, more than the markets are anticipating, and you might see more of a flight to quality, because that would pull inflation down as well. We were trying to figure out how the Venezuela situation would affect this. On the surface, we would have thought maybe a little bit of a flight to quality. That didn't really happen. I mean, stocks were up yesterday.
Gold maybe is the only thing.
Yeah, it didn't really impact the bond markets. If we were to get an increase in oil supply, which there's a lot of moving parts there as well, because we already have plenty of supply. But if oil prices continue to come down, that could weigh on inflation, and then maybe that pulls long-term yields down a little bit. But for the most part, our outlook hasn't changed much. Steeper yield curve, 10-year holding near 4%.
Stephanie, I did want to ask you, as the affordability discussion persists, and it probably will have an effect on Washington or continue to have an effect, is there any chance that we see more stimulus, for example, next year? Or would Congress not support that even if the president? Is that something you're factoring into your models at all?
No, unless you get really bad economic conditions first. So the idea of doing $2,000 stimulus checks are largely not on the table unless you see a real weakening in the labor market, which isn't our call. So if we're wrong on the economy and you get a real slowdown, then sure, the Congress will react. But they are incredibly unlikely to do some sort of stimulus package in advance of a real economic slowdown. The economy's fine. That was what we've seen. The GDP numbers recently were pretty good or quite good. You're not really seeing any real cracks in the economy. So I think it's very much off the table. The affordability issues will continue to be a problem. And by the way, if we got more stimulus, affordability could become more of a problem because then you might see inflation.
Right. Yeah, exactly. So I don't know. It'll be an interesting year. And I'm sure I'll talk to you guys both many times before the end of it. Thank you so much. Appreciate it.